Two people can earn the same salary, save the same amount of money, invest for the same number of years, and still end up in completely different financial worlds. One becomes rich, the other becomes wealthy. At first, those sound like the same thing, but they're not. In fact, understanding the difference could completely change how you build your future. Most people spend years arguing about stocks versus real estate, trying to figure out which one is better. But here's the strange part. The wealthiest people rarely think that way. They understand something most investors never notice. And by the end of this video, you'll understand why stocks made one investor rich while real estate made him wealthy. When Ryan landed his first full-time job at age 24, he became obsessed with a simple question. What should he do with his money? Every paycheck left him with a little extra cash, not enough to become rich overnight, but enough to start investing. Like millions of people, Ryan opened YouTube, searched investing videos, and immediately got overwhelmed. One expert claimed stocks were the greatest wealth-building machine ever created. Another insisted real estate was the fastest path to financial freedom. Everyone seemed certain, everyone had charts. Everyone had success stories. But here's the strange part. The more Ryan learned, the more confused he became. Most people assume investing is about finding the best asset, the winner, the champion, the perfect place to put money. And that's where things get interesting. Ryan eventually realized he was asking the wrong question. Instead of asking which asset was better, he should have been asking what each asset was designed to do. Because stocks and real estate create wealth in completely different ways. This changes everything. Imagine a hammer and a screwdriver. Both are tools. Both can build something valuable, but they solve different problems. Stocks and real estate work the same way, yet most people spend years comparing them as if they're competing in the same game. Most people never notice this. Ryan didn't know it yet, but understanding that difference would completely reshape his financial future. Ryan decided to start with stocks. The reason was simple. They were easy. He didn't need a large down payment. He didn't need tenants. He didn't need repairs. Every month, he invested $500 into a broad market index fund. Nothing exciting happened. Not in year one, not in year two, not even in year three. And that's where things get interesting. Most investors quit during this stage. They expect investing to feel exciting. They want visible progress. They want dramatic results. Instead, they get boredom. But here's the strange part. Boredom is often where wealth begins. Ryan kept investing every month. Rain or shine, bull market or bear market. He treated investing like brushing his teeth. It wasn't emotional. It was automatic. Slowly, something started happening. The money he invested began generating returns. Then those returns generated more returns. Then those returns generated even more returns. This changes everything. Imagine pushing a giant flywheel. At first, it barely moves. Every push feels useless. But eventually momentum takes over. The wheel starts turning on its own. That's exactly what compounding does. By age 35, Ryan's portfolio was growing faster than his monthly contributions. By age 40, the growth became even more dramatic. Suddenly, his investments were making more money than he was adding himself. Most people never notice this because they quit too early. The stock market rewarded Ryan for one reason: time, not intelligence, not predictions, not luck, time. And by his early 40s, Ryan had accumulated a portfolio that most people would consider impressive. He had become rich, but he still felt like something was missing. Ryan's net worth looked great on paper. Every year, the numbers grew larger. Every year, his investments climbed higher. But here's the strange part. His life didn't feel dramatically different. He still relied on his job. He still waited for payday. He still worried about what would happen if his income disappeared. And that's where things get interesting. One day, Ryan met an old friend named Maya. She wasn't constantly talking about portfolio balances. She wasn't checking stock prices every day. Instead, she talked about rental income, monthly cash flow, properties, tenants, income arriving whether she worked or not. At first, Ryan dismissed it. Real estate sounded complicated. Repairs, maintenance, vacancies, headaches. Then Maya explained one concept: leverage. This changes everything. Imagine Ryan has $100,000. If he buys stocks, he can invest $100,000. Simple. But with real estate, that same money might control a property worth $400,000. Most people never notice this. The property's value grows based on the entire asset, not just the cash Ryan invested. Suddenly, Ryan realized something. Real estate wasn't simply generating appreciation, it was combining multiple wealth engines at the same time. Property values could rise, rent could increase, tenants could pay down the mortgage, inflation could make debt easier to repay. 4 different forces moving in the same direction. But here's the strange part. The most powerful benefit wasn't any of those things. It was cash flow. At age 42, Ryan purchased his first rental property. The first few months were stressful. There were repairs, unexpected costs, phone calls, small problems. For a moment, he wondered if he had made a mistake. And that's where things get interesting. After the first year, the property started operating smoothly. Rent arrived every month. The mortgage balance slowly declined. Property values increased. The system began working without constant attention. Something fascinating happened. Ryan started viewing money differently. When his stock portfolio grew, he felt richer. When his rental property produced income, he felt freer. Most people never notice this distinction. Wealth isn't just about owning assets. It's about creating options. Imagine having $1 million stock portfolio, but needing your job every month. Now imagine receiving enough passive income to cover your major expenses. The numbers might look similar, the feeling is completely different. This changes everything. Ryan realized that stocks were incredible at building net worth. Real estate was powerful at creating income streams. One increased his wealth, the other increased his freedom. By age 48, Ryan owned several rental properties and a large stock portfolio. Neither asset alone changed his life. The combination did. And that's the lesson most investors miss. If investing were purely about math, everyone would become wealthy. But investing isn't a math problem. It's a behavior problem. Most people know they should invest. Most people know they should save. Most people know they should think long term. Yet very few actually do it. Why? Because human psychology constantly works against us. When markets fall, fear takes over. When markets rise, greed takes over. When friends get rich quickly, comparison takes over. When progress feels slow, impatience takes over. And that's where things get interesting. The biggest threat to your financial future usually isn't the market. It's your own behavior. Stocks create one psychological challenge. They're visible every second. Prices move constantly. News headlines scream for attention. Every day presents an opportunity to make an emotional decision. Real estate creates a different experience. You don't see minute-by-minute price changes. You don't receive hourly updates. You don't constantly watch values fluctuate. Most people never notice this. For some investors, real estate works better simply because it reduces emotional mistakes. The asset forces patience. And patience is often the secret ingredient behind wealth. But here's the strange part. Neither stocks nor real estate can save someone from poor decisions. Every successful investor eventually learns the same lesson. The best investment strategy is the one you can consistently follow. Not for 6 months, not for 2 years, for decades. So what should someone actually do? Ryan eventually developed a simple framework. First, build a financial foundation. Create an emergency fund before chasing investments. Stability comes first. Second, invest consistently in diversified stock funds. Let compounding do the heavy lifting. Ignore the daily noise. Focus on decades. Third, increase your income. Most people obsess over investments while ignoring the fastest wealth building tool they have, their earning power. Fourth, study real estate carefully before jumping in. Understand cash flow, understand financing, understand risk. Most people never notice this. Buying real estate doesn't automatically create wealth. Buying good real estate creates wealth. Fifth, think in systems instead of assets. This changes everything. The goal isn't finding the perfect investment. The goal is creating multiple engines working together. One engine builds net worth, another creates income, another provides flexibility, another protects against inflation. When those systems work together, wealth accelerates. Ryan started his journey searching for a winner, stocks or real estate. He assumed one asset had to be superior, one had to be the secret, one had to be the answer. But here's the strange part. The real answer wasn't choosing sides. Stocks made Ryan rich because they harnessed the power of compounding. They turned consistency into growth. They transformed time into wealth. Real estate made Ryan wealthy because it created income. It generated leverage. It expanded options. It gave him freedom. And that's where everything comes together. Rich is having money. Wealthy is having choices. Rich is watching your net worth grow. Wealthy is owning assets that buy back your time. Most people spend years debating which investment is better. The smartest investors eventually realize they're asking the wrong question. The better question is this: how can I build a system where every asset works together? Because the goal was never stocks. The goal was never real estate. The goal was freedom. And once you understand that, you stop looking for the perfect investment. You start building the perfect financial machine. And that changes everything.